Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Tower Semiconductor.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And real quick before we jump into the analysis, remember to check out the special 14-day trial link below in the description for StockOracle.
Right, yeah. StockOracle is this really powerful AI-aided stock research platform.
Exactly. But, we always have to remind you, this is not financial advice, right? It's not a trading signal service, and it doesn't give you real-time market data.
Yeah, and full disclosure, that link is an affiliate link, so the channel may earn a commission at no extra cost to you.
And one last thing on that, StockOracle's AI insights and valuation estimates, well, they can be incomplete or sometimes just wrong, so you should always verify the important facts yourself.
Always. All right, so let's get into Tower Semiconductor. Ticker symbol is TSEM.
Yeah, this is a fascinating setup today.
It really is. Because, look, what happens when a company posts these, record-breaking, accelerating profits, but at the exact same time, they're just bleeding millions of dollars in free cash flow?
Right. It's a total paradox.
Exactly. And we're talking about a stock that has skyrocketed 461% in a single year.
Which is just wild.
Yeah, it bounced from a 52-week low of just $46 all the way up to $265.48. But here's the kicker. The company's own executives are currently selling off tens of thousands of shares, and they aren't buying a single one.
Yeah, that insider activity is definitely something we need to unpack, because when a stock goes on a run of that magnitude, up over 400%, you are no longer trading on historical performance.
Right, you're trading on a promise.
Exactly. You are trading on the expectation of basically flawless future execution. The margin of safety just completely shrinks.
So our goal for this analysis is to really tear down that expectation. We want to see what's holding it up.
Look under the hood, so to speak.
Yeah, we're going to look at the hard financial data, see the actual capital moving through the business, and dissect this highly specific technological moat they have.
The silicon photonics side of things.
Right, which is supposedly driving this massive parabolic run. And crucially, we need to examine the hidden structural risks, the geopolitical risks, and just figure out if this rally is built on bedrock fundamentals or if it's just heavily leveraged speculation.
Which is such an essential exercise right now for wealth building. You have to know if the engine of growth can actually sustain that kind of altitude.
Well, let's start with that engine because, the top-line revenue trajectory is undeniably pointing upward.
Oh, absolutely.
Looking at the data, Tower called in $1.433 billion in 2023.
All right.
Then that ticked up slightly to $1.436 billion in 2024, and then, boom, stepped up much more aggressively to $1.566 billion in 2025.
Yeah, the scaling is definitely there. And their net income has been climbing alongside it, too. They hit $220.4 million in 2025.
Which establishes a really steady, profitable baseline.
It does, but, the market rarely hands out a 400% premium just for steady.
Right, there has to be a spark.
Exactly. And the catalyst for this recent re-rating really seems to be their second quarter of 2026.
Oh, yeah, the record revenue.
Yeah, they reported record revenue of $460 million for that quarter alone.
Wow.
Which is a 24% year-over-year increase. And they generated a net profit of $91 million just in that quarter.
See, that 24% jump, that feels like the inflection point. Accelerating quarterly revenue by that much in the hardware manufacturing space?
It's incredibly difficult.
Yeah, it's not like software. You actually have to build things. And management is just leaning entirely into this explosive scaling narrative. They've publicly raised their 2028 targets to a really aggressive $3.6 billion in revenue.
And $1.2 billion in net profit, which is massive.
Massive. And looking at the immediate horizon, their Q3 2026 guidance is expected to beat analyst estimates, slotting in somewhere between $494 million and $546 million.
Right. But to understand how they actually plan to hit those insane 2028 numbers, you kind of have to look at their operational model.
Yeah, let's talk about that. Because they operate as a specialty pure-play foundry.
Which basically means they don't design their own consumer-facing chips.
Right. So to use an analogy, it's like they're a highly specialized ghost kitchen.
Oh, I like that.
Right. They don't have a restaurant out front with their own branded food. Instead, they're in the back cooking up the most complex, high-tech recipes for other massive tech companies.
Exactly. They take these proprietary designs from other companies and manufacture them. And they are doing it with remarkable efficiency. Their trailing 12-month net margin currently sits at 37.56%.
That is just wild. taking home nearly 38 cents of profit on every single dollar of revenue in a physical manufacturing business.
It indicates they have serious pricing power.
Yeah, they aren't just churning out cheap commodity parts. They are building high-value components where precision is everything. But looking at these aggressive 2028 targets, I do have a fundamental concern here about their liquidity and scale.
How so?
Well, management is projecting this massive leap to $3.6 billion in revenue
Yeah.
in just a couple of years. But in the foundry business, scaling capacity isn't like flipping a switch on an AWS server.
No, not at all.
It requires immense billions of dollars physical infrastructure. So my question is, can a specialty foundry actually scale at that velocity without degrading those 37% margins? Or just fundamentally breaking their operational model?
Yeah, and that right there is the structural tension at the heart of this stock. Maintaining a 37% net margin while aggressively expanding your footprint is a total high-wire act.
Because the market is pricing in absolute perfection, right?
Exactly. The current valuation assumes that every new fabrication line Tower builds is going to immediately run at maximum utilization with high-margin orders.
Right. And if they overbuild,
If they overbuild or if demand softens even slightly, the depreciation costs of those empty fabs will just eat into that 37% margin incredibly fast.
which means they need a catalyst.
Yeah.
They need a specific, highly coveted product offering that basically guarantees their new fabrication lines will be fully booked out for years.
Right. They need a serious technological moat.
And according to the research, that moat is their heavy concentration in silicon photonics, or SiPho,
Yeah.
alongside indium phosphide photonics.
Yeah, and it is a fascinating edge. To really grasp the significance of it, you have to think about the physical limitations of traditional semiconductor architecture.
Right, the old copper wires.
Exactly. For decades, standard chips have relied on electrons moving over copper interconnects to transfer data. But as we push deeper into the AI era and we expand these hyperscale data centers, forcing more and more electrons through microscopic copper wires,
It creates severe resistance.
tons of resistance. You get speed bottlenecks, signal degradation, and just a massive amount of heat.
So silicon photonics basically shifts the whole paradigm from electricity to light.
Yes.
Instead of electrons on copper, you are routing photons through silicon waveguides directly on the chip itself.
Precisely. Photons travel faster, they carry exponentially more bandwidth, and they generate a fraction of the heat. But here is where the technical nuance of Tower's offering really matters.
It's the indium phosphide part, isn't it?
Exactly.
Why are those two tied together? Why not just use silicon for everything?
Because silicon actually has a major physical limitation. It is an indirect band gap semiconductor.
Okay, which means what in plain English?
It's a physics term that basically means silicon is terrible at emitting light.
Oh, I see.
Yeah, silicon can route the light beautifully once it's there, but it cannot generate the laser beam itself. Indium phosphide, on the other hand, is a direct bandgap material, so it makes excellent lasers.
Okay, so Tower's specialty is integrating these indium phosphide light sources directly into the silicon photonics architecture.
Yes. And doing that integration at the microscopic level is notoriously difficult to manufacture at high yields.
So by mastering that specific process, they aren't just a generic ghost kitchen anymore. They kind of hold the keys to the next generation of data transfer.
They do, and what's really smart is they are actively working to lock the entire industry into their specific manufacturing process.
Right, the software play. I was looking at this. They recently announced an open light photonic process design kit, a PDK, which is now available within Cadence ED tools.
Yeah, and that is a highly strategic move. EDA, or electronic design automation, is the software environment where engineers actually draw and simulate the chip architectures.
It's like the AutoCAD for microchips.
Exactly. So by embedding their specific PDK into Cadence, which is an industry standard, Tower is essentially handing the world's chip designers a library of pre-validated blueprints.
Blueprints that are optimized exclusively for Tower's fabrication machines.
You got it. It creates incredible stickiness.
Because if an engineering team spends, millions of dollars and thousands of hours designing a photonics chip using Tower's PDK in Cadence, they can't just turn around and easily ask a competitor to manufacture it.
Nope. The math is tied to Tower's physical equipment. The switching costs are massive.
And the financial projections attached to this lock-in are huge. The revenue run rate for Tower's silicon photonics alone is expected to reach $1 billion by the fourth quarter of 2026.
Yeah, and that tangible projected revenue stream is likely what prompted BofA Securities to initiate coverage with a buy rating and a massive $367 price target.
Okay, The narrative is super compelling, but I do want to apply some skepticism here regarding their actual competitive moat.
Sure.
Because looking at the available data, there is zero information comparing Tower's market share against the established titans of the foundry world, companies like TSMC or Global Foundries.
Right.
Without that comparative data, how do we evaluate their true market position? I mean, we know they have a great process, but TSMC has capital expenditure budgets that dwarf Tower's entire market cap.
Oh, by multiples.
So are investors just taking a leap of faith that Tower can defend this niche against a giant who suddenly decides they want a piece of the photonics market?
It is a significant blind spot in the bull thesis, frankly. TSMC is a behemoth. If they decide to aggressively commoditize silicon photonics, it could severely compress Tower's margins.
Yeah.
The counter-argument is that photonics integration is so specialized that a promise focused on, cutting-edge logic nodes might not pivot fast enough to crush a nimble, specialized player like Tower.
But it's a risk.
Absolutely. Without market share data, you are investing in the premise that Tower's intellectual property and process know-how are completely unassailable.
And paying for that unassailable premise brings us to the harsh financial reality check.
Yeah.
Because developing this tech and building out the fabs to hit that $1 billion run rate...
It takes cash. A lot of it.
Exactly. When we look at the valuation and the cash flows, the price of this perfection starts to look a bit precarious.
Demanding is the word I'd use. Tower's trailing 12 months PE ratio is sitting at 102.02.
Wow.
And their price-to-book ratio is 9.62.
A PE over 100 for a capital-intensive hardware manufacturer is exceptionally rare. I mean, you typically see multiples like that in software-as-a-service companies, right?
Yeah, companies that have near zero marginal cost for adding a new user.
Exactly. But Tower has to build billion-dollar physical factories to add capacity. That premium valuation relies entirely on that 2028 growth actually materializing.
And if a hardware company trading at 100 times earnings misses a growth target, the multiple compression can be vicious. But honestly, the valuation metric is just the surface. The deeper concern is their cash flow mechanics.
Yeah, let's unpack that, because this is exactly where the contradictory data points start popping up. They're posting record net income, they're raising forward guidance, but if you actually trace the cash, their operating cash flow is shrinking.
Yeah, it dropped from $676.5 million in 2023 down to $448.6 million in 2024.
And then fell even further to $395.4 million in 2025.
That is 2 consecutive years of declining operating cash flow.
During a period of supposedly explosive growth.
Exactly. And furthermore, in 2025, their capital expenditures, so the money spent on physical assets and equipment.
The CapEx.
Right. Their CapEx totaled $444.4 million.
Which means they spent more on CapEx than they generated from their operations.
Yes.
And that resulted in a negative free cash flow proxy of almost negative $49 million for 2025.
Correct.
So I have to question the sustainability of this. Is this simply the expected standard trough of a semiconductor CapEx cycle where, you have to buy the expensive lithography machines years before the revenue actually hits?
It could be.
Or is bleeding free cash flow while trading at a 100 PE a giant structural red flag that they're struggling to fund their own expansion?
Well, the mechanics of semiconductor CapEx basically dictate that cash outflows will always precede revenue recognition, often by a timeline of 2 to 3 years.
Because building a clean room and installing the tooling is astonishingly expensive.
Astonishingly expensive. So mechanically, negative free cash flow during a heavy capacity expansion phase is actually pretty normal for a foundry.
Okay, so not a red flag in isolation.
Right. The structural risk, however, is the timing of the return on invested capital.
The risk of a mismatch.
Precisely. If Tower burns through $500 million in CapEx to build out this photonics capacity, and the hyperscale data center demand is delayed by even a few quarters,
then that negative free cash flow isn't just a temporary growing pain anymore.
it becomes a liquidity drain.
Yeah.
You are paying a premium multiple for a company that is currently burning cash on the strict promise that 2028 will be absolutely flawless.
And because they require that absolute precision in their execution to justify the 100 PE valuation, they are entirely exposed to external disruptions.
Right. They need the global supply chain to remain completely stable.
Which naturally shifts our focus to the macroeconomic risks and the geopolitical landscape.
Yeah. And, if we look at the technical setup first, the market currently seems to be totally ignoring those external risks.
Yeah, the chart looks technically dominant.
It really does. It's trading well above its 200-day moving average, which is at $176.45. And it has a really healthy relative strength index, or RSI, at 60.78.
So the chart looks bulletproof, but the geopolitical reality is incredibly volatile right now. And we need to look at this impartially, strictly focusing on supply chain mechanics,
Absolutely.
because there are looming trade policy risks. For instance, President Trump has posted about potential massive tariff increases on Chinese products.
Right.
And alongside that, there are unconfirmed reports that the FCC is exploring restrictions on Chinese optical modules.
And this matters because the semiconductor supply chain is arguably the most globally intertwined manufacturing process on Earth.
Components, raw materials, testing protocols, they cross international borders constantly.
Exactly. So while Tower might not have direct exposure flagged in these specific reports, sweeping tariffs or FCC bans on optical modules would create massive friction.
Because those modules are intimately tied to the photonics ecosystem.
Yeah. It introduces unpredictable variables into a business model that, as we establish, requires 37% margins to sustain its valuation.
Right, if their downstream clients suddenly can't source the complementary components they need due to tariffs, those clients are going to delay their orders from Tower.
Exactly. The delay cascades upstream. And honestly, the market may not have fully priced in these geopolitical tariff risks simply because the exact timing and the scope of them are totally unresolved.
The threat is abstract right now, whereas the Q2 revenue growth is a concrete number on a spreadsheet.
Well said.
Which brings us to the people who understand this company's concrete reality better than anyone, the executives.
Ah, yes. The insider selling.
Yeah, there's a fascinating data point regarding insider trading, which is categorized as a soft negative signal.
Right.
In the recent period, there were absolutely zero open market purchases by insiders. None.
Zero.
However, there were 10 open market sales, amounting to almost 67,000 shares sold.
Now, analyzing insider selling requires some nuance, right? Executives liquidate shares for a variety of personal reasons.
Like tax obligations or diversifying their net worth.
Exactly, or just standard scheduled selling programs. So it does not automatically signal that they believe the company is structurally unsound.
I understand the nuance, but let's just examine human behavior against the timeline they've presented to the public.
Okay, let's do it.
Management is projecting a massive leap to $3.6 billion in revenue by 2028. They are out there touting a $1 billion run rate for their photonics division by the end of 2026.
Right.
If you are an executive and you genuinely believe your company holds the undisputed foundational technology for the next generation of computing, why are you selling tens of thousands of shares right now?
It's a fair question.
I mean, if they truly believe the 2028 targets are locked in, the current price of $265 would technically be a massive discount, yet nobody is buying.
Yeah, it's a highly rational skepticism on your part. While it might not indicate an impending collapse, it strongly suggests that the executives view the current valuation trading at 100 times earnings after a 461% run as fully priced.
Right. They're choosing to monetize their equity at this premium rather than wait for the 2028 targets to actually materialize.
And when the architects of the growth plan are taking chips off the table at these multiples, retail investors should carefully consider the risk premium they are taking on.
Absolutely. So, synthesizing all of this data, we have to weigh the technological brilliance against the financial and macro realities.
Yeah, and the overall assessment gives Tower Semiconductor a rating of 6.
Which equates to a neutral stance.
Exactly. It's a neutral investment rating. The analysis recognizes the validity of the silicon photonics growth engine, but the expectations have to be tempered based on the demanding valuation and the cash flow burn.
Right. And the research horizon to watch is really the next 6 to 12 months. There are 2 critical milestones you need to monitor.
First up is their Q3 2026 earnings release in early November.
Yeah, you need to see if they meet that guidance midpoint of around $520 million. Any top-line miss will severely punish a stock trading at these multiples.
And the second milestone is verifying if they actually achieve that $1 billion silicon photonics revenue run rate by the fourth quarter of 2026.
Because that specific metric is the keystone for their entire 2028 growth projection.
It really is.
So to bring this all together for you, Tower Semiconductor is executing an incredibly complex high-wire act. On one side, they possess a phenomenal, highly defensible technological advantage.
Integrating those indium phosphide lasers with silicon photonics.
Right, solving the data center heat and speed bottlenecks. They're posting record revenues and locking clients into their EDA blueprints.
But on the other side,
you are being asked to pay a PE ratio of over 100 for a hardware manufacturer that is currently bleeding free cash flow to fund its expansion, all while navigating a fragile global supply chain threatened by looming tariffs and seeing absolutely zero insider buying. We can't tell you to buy, sell, or hold, obviously. You have to weigh the upside of the tech against the downside of the valuation yourself.
And it forces us to look beyond just Tower's immediate financials and consider the broader long-term view. We spent this time analyzing whether Tower can successfully commercialize silicon photonics. But if we assume they do, if light truly replaces copper and electricity as the standard for high-performance data transfer, it introduces a massive tangential risk to the rest of the market.
Oh, that's an interesting thought.
Right. What happens to the multi-billion-dollar legacy data center infrastructure industry? If this photonics architecture becomes the new baseline, we might be looking at an unprecedented wave of obsolete hardware across the traditional semiconductor ecosystem.
Wow, an entire generation of copper-based networking gear could become stranded assets almost overnight.
Exactly.
That is a fascinating ripple effect and a critical dynamic for you to keep an eye on as those early November earnings approach. And that rating 6 neutral score is something to keep in mind, too.
Definitely.
Well, that wraps up today's look at Tower Semiconductor. If you find our talks useful, please consider subscribe, like, and comment underneath.
And again, don't forget to grab that special 14-day trial link for StockOracle down in the description to check out their AI insights for yourself.
Thanks for joining us on Smart Wealth with Joshua. We'll see you next time.